It is Friday evening after work, and you are sitting in your car in the parking lot. The engine is off, the keys are in your lap, and you are staring into space. You just got paid. There is more money in your bank account than usual. It is not a fortune, just a little above the basic level that has been stagnant for months. And for the first time in a long while, you are not immediately calculating which bills to pay first. You are not panicking about paying the rent before your paycheck hits. You are just sitting there realizing that something has changed. The money is there, and you don't need to touch it right now. This feeling, this moment of not needing, is the threshold that most people chase their entire lives without realizing what it truly is. My name is Logan Wolfe, and I've studied the stages people go through during the transformation of their relationship with cash. If you've ever felt that strange mix of relief and confusion when you had money left over at the end of the month for the first time, subscribe, because what I am going to show you isn't about saving a certain amount of money. It is about recognizing the internal shift where cash stops being a source of anxiety and transforms into something else. What most people misunderstand about financial progress, in my view, is that they think it is linear. Earn more, feel better, save more, experience less stress. But real psychology doesn't progress in a straight line. It moves in stages. Money sitting in an account that you don't need to withdraw immediately triggers a transformation that most people never experience, because they don't save it long enough. The traditional narrative says spend less than you earn and invest the difference. Technically, it makes sense, but it ignores spending habits and human psychology. To be able to invest consistently, you need to reach a threshold where money doesn't feel like oxygen, a stage where having money doesn't create pressure to spend, and not having money doesn't trigger survival panic, based on my own experiences and research. This stage has nothing to do with the amount. There are two reasons for this. One is that we live in an age of consumption and therefore conform to the system. The other is related to the response your nervous system gives when you see money that you don't have to spend immediately. In the 1950s and 60s, Americans kept their cash reserves at home. Physical banknotes were in drawers, envelopes, shoe boxes. Banks paid minimal interest. The psychological security of physical cash overshadowed financial logic. So what about today? The average American has less than $500 in liquid savings that they can access without selling something or borrowing. It is not because they earn less relative to inflation, because the entire financial system is optimized to prevent cash accumulation. Direct deposits ensure money flows through banks. Automatic payments drain your accounts before you even notice. After living paycheck to paycheck for months or years, your brain gets reprogrammed. Money becomes something that flows through your life, never accumulating. This can foster a scarcity mindset dating back to the 1960s. Every dollar that comes in is allocated before it even reaches your hands. Your balance fluctuates, but it may never increase in any meaningful way. You don't have a bad relationship with money. Psychologically, you may begin to adapt to an environment where money doesn't stay long enough to change your relationship with it. Then something happens. Suddenly, a notification pops up on your phone, tax refund. You sell something. You have a good month resisting overspending. Suddenly, you have cash that doesn't need to be spent immediately. Your brain doesn't know what to do. You've been in allocation mode for so long that saving mode feels strange to you. This is the first money threshold that most people break out of the cycle and never reach. When cash becomes an asset instead of a flow. When you see a number representing a buffer instead of a countdown. The transformation of cash from flow to asset creates the foundation for all other financial stages. Like a domino effect, investing without passing this stage can seem abstract to most people. Saving feels like deprivation. Money seems to exist only to be spent. Here is the answer most people don't realize they're looking for. The financial stage triggered by cash isn't about having enough money to retire or buy a house. It is about reaching an internal state where money ceases to be the primary lens through which you evaluate every decision. Car repairs are annoying, but not catastrophic. An unexpected bill doesn't cause panic. You can say no to overtime because you don't need the extra money this week. This stage arrives when your cash reserves cross the threshold needed for your nervous system to stop viewing money as a scarce resource. For some, this is an amount that covers 1 month's expenses. For others, 3 months. For others, 6 months. The number doesn't matter. What matters is that you internally accept that you are no longer in survival mode. You now have a margin, and margin changes everything. Psychology is not about money itself. It is about what money represents. It is proof that you can earn more than what you immediately need. It is proof that your income exceeds basic survival costs. It is confirmation that you can resist the urge to spend everything you have. Banks actively work against this stage because people with cash reserves are less profitable for banks. People who spend their paycheck as it comes in and occasionally overdraw their account generate fee income for the bank. People who never overdraw their accounts and have reserves generate no income. The industry's ideal customer is not someone who can breathe easy, but someone who is barely getting by. Once the threshold of cash hardship is crossed, spending changes. Previously, every purchase was necessary or created an uncertain sense of guilt. Afterwards, a third category emerges. Optional, but without creating guilt. Being able to buy something without calculating whether it will cause problems 3 weeks later. When people say they want wealth, they mean mental freedom, not having to constantly calculate finances. It is not necessarily that they want luxury. They want mental space to not constantly think about money. But there is a trap. People reach the point where cash provides a buffer, then immediately start spending at a new baseline level. Cash provided security, reduced stress, made them feel they could afford more, which then consumed the cash and eliminated the security. They experienced this phase but couldn't sustain it because they didn't realize what caused the change. People who successfully stay here see the buffer as untouchable except for real emergencies, not for wants. For emergencies now. There are people who have a regular monthly cash flow but use credit cards extensively in their daily lives. So when they get cash in hand, they transfer an average of 40% or 50% of that money to credit card payments. These people pay commissions to banks every month. And I also think they don't feel the value of the money they have in their hands, because I used to be like that too. If your bank debt is exactly $0, then you can understand the power of the cash you have in your hands. Think about it this way. Let's say your average annual income is $60, but due to irregular spending habits, you pay $2,500 to the banks every month and then spend that amount again the following month, unable to break out of this cycle. In my opinion, this inability to understand the value of money is what leads to constantly paying commissions to the banks. Because if you imagine that $60,000 laid out in stacks of cash on the table in front of you, you would understand the value of that money because you could see it tangibly and hold it in your hands. But think about how, due to your habit of irregular and unplanned spending, you would struggle to put even $10,000 on that table. The money would probably seem insignificant to you because it is a small amount as a tangible asset. Consider the other way around. More cash makes people feel that money is valuable, which indirectly corrects their perception of money and leads them to spend less irregularly and haphazardly. Breaking this endless cycle, the psychological benefit comes from knowing that cash exists, not from spending it. The moment you start regularly dipping into reserves for non-emergencies, you begin to see cash not as an asset, but as a flow. Someone accesses their cash reserves, they relax. The underlying anxiety disappears. They sleep better. They are less irritable. Their relationships improve. Then they see something they want, a vacation, a gadget, an upgrade. They think, I have the cash for this. True. But spending it may mean choosing temporary pleasure over constant psychological relief. Most people make this trade, off without realizing it. They trade lasting benefit for a temporary boost. 3 months later, they're back where they started. This stage isn't about never spending. It is about recognizing what cash provides and protecting that first. The shift from scarcity to sufficiency is more valuable than any purchase. Once this stability is achieved, investment behavior changes completely. Previously, when cash was scarce, investing felt like giving up money you might need later when cash provided a buffer. Investing felt like putting surplus money to work. The obstacle to consistent investing is not understanding stocks. Speaking of stocks, I would like to remind you that this channel does not provide investment advice. It is about becoming financially literate. Therefore, telling someone who lives paycheck to paycheck to invest for retirement seems psychologically counterproductive. Their nervous systems correctly recognize that they need a cash buffer before investing for growth. Forcing someone to invest before reaching the cash stage creates guilt without changing their behavior. Once the cash stage stabilizes, a different shift will begin. People start thinking in longer time frames. When money is tight, you think in days or weeks. When you have a cash buffer, you think in months. As investments grow, you think in years or decades. This temporal expansion is the basis of long-term planning. However, this only works once the cash phase is secured and sustained. The relationship between cash and investment is sequential, not parallel. If your current situation is fragile, investing for the future can be a difficult start. In my opinion, the psychological foundation must be solid before building on it. I think it is very important for a person to be confident in themselves when they are going to do something. Some try to skip this. They aggressively invest by adding their paychecks to their investments. Then an emergency arises, there is no buffer, and they are forced to sell their investments at a loss or take on debt. It is like building the second floor without a solid foundation. Here is a deeper insight. The cash phase is not just about ensuring stability. It is about fundamentally rebuilding your psychological relationship with money. When you maintain your buffer each month, your brain reacts less to money stress. Every unexpected expense covered by reserves without panic reinforces that you are no longer in survival mode. This can create lasting changes in your relationship with money, work, spending, and risk. Someone who has lived through a cash phase for a year thinks differently. They are calmer in negotiations because losing their job is not catastrophic. They are more willing to spend more on quality. Since their needs are covered by reserves, they will become less prone to impulsive purchases. This probably creates a paradox. The less you spend your reserve, the more value it provides. The moment you see it as spendable, it ceases to be a reserve. The benefit comes from protecting, resisting, something you can spend but don't. Banks won't want you to understand this, because it is harder to make money from people in the cash phase. Someone with stable savings doesn't need high-interest loans. They don't overdraw their account. They don't carry a balance. The cash phase means giving up one of the most profitable parts of consumer banking. Banks structure their products to prevent this. Low savings rates ensure cash doesn't grow. Automatic payments ensure cash leaves as quickly as it arrives. After successfully maintaining the cash stage for a long time, something else changes. People start making different life decisions. They can leave well-paying but consuming jobs because they have a buffer for this risk. They start side projects because they don't need every penny. The concept of freedom becomes more meaningful. They move to a lower cost area because expensive cities were necessary when they were barely getting by, but become optional when they have a margin. The cash phase is a turning point where financial stability becomes the foundation of life design rather than a constraint. Previously, money determined their choices. You would accept a higher paying job even if you didn't like it. You would stay in the expensive city because your job was there. You couldn't pursue non-income, generating interests because every hour had to be converted into money. Once stability is achieved, this equation reverses. Money ceases to be the dominant variable that overshadows everything and becomes just one of many variables. You make decisions based not only on how much money you earn, but also on what you want. This freedom does not require wealth in the traditional sense. It requires reaching a psychological stage where cash becomes a reliable buffer, rather than a scarce resource, the timeline changes significantly. Someone with a modest income who keeps their spending below their income can reach this stage faster than someone with a high income who spends up to their limit. The transformation occurs not when income reaches a certain level, but when cash continues to accumulate. When I reached this point and maintained it, I experienced some changes. Some years I was in a cycle of spending my cash, depleting it, and then rebuilding it. Then, I decided to treat the buffer I had created as untouchable except for emergencies. The first few months were uncomfortable. When I saw something I wanted, resisting it made me feel deprived. Around the fourth month, something shifted. Knowing I had cash became more valuable than anything I could buy. My constant anxiety disappeared. I slept better. I made better decisions because I wasn't acting out of desperation. This internal shift is what the cash phase provides. It is not about the amount. It is the transformation that happens when your nervous system accepts you are no longer in survival mode. This acceptance comes from consistent evidence that you have a margin. The phase triggered by cash forms the foundation for all other phases. Without this phase, your investments may be unstable. Career transitions may seem risky because there is uncertainty. Major purchases seem overwhelming to most people. Once this phase is solidified, everything will become accessible over time. Obstacles disappear because you are acting out of sufficiency, not scarcity. What do you think about the credit card dilemma? Does the cash in your hand make you feel powerful in life? You can share your thoughts on the power of cash in the comments. That is all I have to say in this video. See you soon with more specific topics.